Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Benzinga Pro. I'm your co-host Joel Elconin with Spencer Israel, and we have a special guest on the line, and that's Bob Walters. He's chief economist and vice president of capital markets at our own Quicken Loans. Bob, how you doing this morning?
I'm doing well. How are you guys?
Doing good. Well, thanks for coming on the show here. A lot of crazy things that are going on in the markets here, with the futures down quite a bit. But just want to go to you to get a pulse on the housing market. The Fed raised the interest rates here at the end of the year, and they're threatening to do it several more times in the upcoming year. I mean, you see a lot what's going on with the economy because you're dealing with with the people that are buying houses and getting loans. I mean, from your observations, what you've seen in, let's say, 2014, 2015, is this, a growing, expanding economy?
It is. It's interesting. We've got every day right now this year, we've seen the stock market drop. We're going to drop again today, at least at the open. From that perspective, it looks pretty scary. On the other hand, you've got interest rates falling, at least long-term interest rates falling, so mortgage rates getting more attractive. I was at the pump yesterday. I think I paid $1.70 for a gallon of gas. That's putting an extraordinary amount of money into homeowners' pockets, into Americans' pockets. And so we've got unemployment down at 5%. I mean, is it boom times? Not necessarily, but things are doing well. So it's really kind of a dichotomy between a stock market that right now is selling off pretty hard and actually some pretty good undercurrents for the economy and certainly for the housing market.
All right, so, I mean, you're kind of going with the Fed stance here. Maybe they have some data that, we're not privy to as far as, strength in the economy. Just going back to the mortgage market here, I mean, you had the recent rate hike. Did you see like a rush of applications, for people, I'm worried about rates going up, even though they're very low on a relative basis? Did you see any kind of increase ahead of this Fed rate hike?
We did. Every time that the Fed's in the news, especially this time, given that the last time the Fed had actually increased interest rates was, I believe, 8-9 years ago. So it was news. It got into the popular press, beyond the financial press. So it got into the mind share of the average person. So the average person, who had been thinking about refinancing or maybe is on the bubble to buy a house, they were reaching out, coming into the market. So we did see a bit of a rush on that. We try to talk to people and explain to people that there's a huge difference between what's going on with Fed funds and long-term interest rates, and they're not necessarily, over the long haul they move directionally, but they're not necessarily tied one for one. So, but we did see a rush of people that, especially refinancers. Those were the people who that's a much more discretionary sort of a move than a purchase, which involves a lot of other things. A lot of refinancers moved into the market and continue to.
Okay, so you're not seeing any comparisons to, 2008 here with the housing bubble and, credit being expended to people. I mean, as far as if something's going to take down the market, it's not going to be the housing market.
Not even close. In fact, you can make an argument that mortgage credit's a touch tight. It's improved quite a bit over the last year, but any of the kind of lax lending things that were happening back in 2007-8 are long gone, and right now it's actually a pretty attractive market. And you're seeing predominantly 30-year fixed mortgages, fully documented mortgages, and I think home prices, while rising, they're rising at a measured level. There's far from a bubble in house prices.
I mean, you still look at 30-year rates, in the 4. I mean when I bought my first house, they were nowhere near that. So on a relative basis, rates are still extremely low. Want to talk to you about some price action in LendingTree the other day, and we listened to the comments. They seemed like pretty benign comments. What the street seized on was they reaffirmed guidance for the last quarter, fiscal year 2015, but they didn't say anything about 2016, and that spooked the market, spooked investors, spooked the computers, and just thrashed the stock. I mean, I think it lost over 30 points on the day. One of the points that he made was, well, okay, let's say if interest rates are going up, maybe you're not going to see as much, refinancing, but people are going to be more apt to lock in, and that will pick up for the slack in the refinancing. Do you agree with that scenario?
It's the Lending Tree is a very different company than we are. They are primarily a lead generation company. They don't make direct loans to people. So we're an actual lender. They're more of a marketing company, a lead aggregator. As far as his point, I mean, I think that the refinancing activity is actually going to be more robust, at least for the next quarter, than it has been for quite some time. And the 10-year Treasury is flirting with going below 2. Long-term mortgage rates are going below 4. Anytime we see that happen, we see a surge in refinancing activity, and home purchases have been steadily increasing now for a few years, and I expect that trajectory to continue. So from that aspect, I think there's going to be a considerable amount of demand for mortgage. I know Lending Tree does other things other than mortgage as far as provide leads to other different parts of the financial community, but I think it's going to be 2006 will be a good year for the mortgage market.
Okay, and just finally, before we let you go, you seem to be, in line with the Fed here. Are you in line, or can you foresee 3 more interest rate hikes in the upcoming year?
That's a great question. And if you'd have asked me 3 weeks ago, I'd have said unlikely, but maybe 2. Now, it'll be very interesting to see if they want to maintain a path. You could see a path now for no more increases. You're talking about oil in a free fall. You're seeing China slowing down dramatically. You're seeing a lot of challenges in the Middle East that are constraining demand. So while our economy is still doing well, I'm pretty sure that the Fed is going to be real cautious about tapping the brakes to push us into a recession. We're not there, but it's not exactly we're going gangbusters. So I think they're going to be cautious. I do not see 3 increases.
Yeah, I mean, look how much it took them to get that first increase, through the door. We've been on the line with Bob Walters. He's chief economist and vice president of capital markets at Detroit's own Quicken Loans. Bob, thanks a lot for coming on, and we hope we get to speak to you again soon.
I look forward to it. Thanks, guys.